Right now, while you're watching this video, there is a number attached to your name that you cannot see, but banks, landlords, insurance companies, and sometimes even employers can. That number quietly influences how expensive your life will be. It can decide whether you get approved or rejected. It can decide whether you pay low interest or high interest. And over time, it can literally cost you tens of thousands of dollars without you ever noticing it happening. That number is your credit score. Most people in the United States know that credit scores are important, but very few people actually understand how they work. They hear random advice like don't miss payments, don't use too much credit, or open more accounts, without really understanding why those things matter or how the system truly works behind the scenes. Because of that confusion, many people accidentally sabotage their own financial future while believing they are doing the right thing. In this video, I'm going to explain credit scores from the ground up, in plain English, not from the perspective of a bank, not from a finance textbook, but from the perspective of a normal person living in the United States who wants to understand how the system actually works. By the time you finish watching this video, you will understand what a credit score really is, how it's calculated, why it goes up, why it goes down, and how it affects your real life in ways most people never think about. If you've ever felt confused, stressed, or overwhelmed by credit, this video will finally connect the dots for you. Now let's start with the most important idea. A credit score is not a measure of how much money you make. It's not a measure of how smart you are, and it's definitely not a measure of your value as a human being. A credit score is a risk score. From a lender's point of view, it answers one simple question: how likely is this person to pay back borrowed money on time? That's it. Every bank, credit card company, or lender is trying to predict the future. They want to know whether lending money to you is safe or risky. Since they can't see the future, they look at your past behavior and turn it into a number. That number is your credit score. In the United States, the most widely used credit scoring system is called FICO. There are other scoring models, but FICO is the one most lenders rely on when making decisions. FICO scores generally range from 300 to 850. The higher the number, the less risky you appear to lenders. As a rough guideline, scores below 580 are considered poor. Scores between 580 and 669 are considered fair. Scores between 670 and 739 are considered good. Scores between 740 and 799 are considered very good, and scores above 800 are considered excellent. But here's something most people don't realize. Your credit score is not permanent. It changes over time based on your financial behavior. Sometimes it goes up, sometimes it goes down, sometimes it stays the same. It's constantly being recalculated as new information is added to your credit report. To understand why your score changes, you need to understand what goes into it. There are 5 main factors that make up your credit score, and each one represents a different part of your financial behavior. The most important factor is payment history. Payment history makes up about 35% of your credit score, making it the single biggest influence on that number. Payment history simply tracks whether you pay your bills on time. Credit cards, loans, and other credit accounts report whether you make your required payments by the due date. When you pay on time, it helps your credit. When you pay late, it hurts your credit. And the later the payment, the more damage it does. Being 30 days late is bad. Being 60 days late is worse. Being 90 days late is very damaging. Late payments can remain on your credit report for up to 7 years. Over time, their impact fades, but they don't disappear quickly. This is why consistency matters more than almost anything else in credit. One missed payment can undo months or even years of positive behavior, especially if your credit history is short. This is also why automatic payments are so powerful, not because they improve your credit directly, but because they protect you from human error. Forgetting a due date can be expensive in ways people don't realize until it's too late. The second most important factor is credit utilization. Credit utilization makes up about 30% of your credit score. This is one of the most misunderstood parts of the credit system. Credit utilization measures how much of your available credit you're using. For example, If you have a credit card with a $10,000 limit and your balance is $5,000, your utilization on that card is 50%. If you have multiple cards, utilization is calculated both per card and across all cards combined. From a lender's point of view, high utilization looks risky. It suggests that you're relying heavily on borrowed money and may struggle if something goes wrong. Low utilization, on the other hand, suggests control and discipline. A commonly recommended guideline is to keep utilization below 30%, but people with excellent credit often keep it below 10%. What surprises many people is that utilization is based on the balance reported when your statement closes, not necessarily the balance after you make your payment. This means you can pay your card in full every month and still hurt your credit if you're consistently using a large percentage of your limit before the statement closes. This is why someone can be doing everything right and still see their score drop. It's not personal, it's how the system measures risk. The third factor is length of credit history. Length of credit history makes up about 15% of your credit score. This factor looks at how long you've been using credit, including the age of your oldest account, your newest account, and the average age of all your accounts. The longer your history, the better it generally is for your score. This is why people who are new to credit often struggle at first. They haven't done anything wrong, they simply don't have a long track record yet. It's also why closing old accounts can sometimes hurt your score. That old account represents years of experience managing credit. This doesn't mean you should keep every account forever, but it does mean you should think carefully before closing long-standing accounts. The fourth factor is credit mix. Credit mix accounts for about 10% of your credit score. This refers to the different types of credit you have, such as credit cards, auto loans, student loans, or mortgages. You don't need every type of credit to have a good score, but having experience managing both revolving credit and installment loans can slightly improve your score because it shows versatility and responsibility. The fifth factor is new credit. New credit also accounts for about 10% of your score. Every time you apply for credit, a hard inquiry appears on your credit report. A few inquiries are normal, but too many in a short period can lower your score temporarily. This is why frequent applications suggest financial stress or instability. Hard inquiries usually affect your score for a limited time, but they are still part of your credit history. Now that you understand how credit scores are calculated, it's important to understand the difference between a credit score and a credit report. Your credit report is a detailed record of your credit activity. It includes your accounts, balances, payment history, inquiries, and any negative items such as collections or charge-offs. Your credit score is simply a number generated from that report. Errors on credit reports are more common than most people think. Accounts that don't belong to you, payments marked late incorrectly, or balances reported wrong can all damage your score. That's why reviewing your credit report is important. Checking your own credit is a soft inquiry and does not harm your score. If this explanation is already helping you see credit more clearly, take a moment and subscribe to Easy Finance. This channel is here to help you make smarter money decisions with confidence. Now let's talk about some common misconceptions that lead people into trouble. One major myth is that you need to carry a balance to build credit. You don't. You can use your credit card, let the statement close, and then pay the balance in full. You'll still build credit without paying interest. Another myth is that closing credit cards always helps your score. Sometimes it can, other times it can hurt, especially if it increases utilization or shortens your credit history. Another common misunderstanding is believing that income affects your credit score. It doesn't. You can earn a lot of money and still have bad credit. You can earn modest income and have excellent credit. Credit scores measure behavior, not income. Now let's talk about why credit matters so much in everyday American life. A higher credit score usually means lower interest rates. That applies to credit cards, car loans, personal loans, and mortgages. Lower interest rates means lower monthly payments and less money wasted on interest. Over decades, this difference can be massive. Credit also affects housing. Many landlords review credit reports before approving tenants. Poor credit can lead to higher deposits or rejection. Insurance companies sometimes use credit-based scores when setting premiums. Some employers review credit reports for certain roles. This is why credit is not just a financial concept. It affects your lifestyle, your stress levels, and your long-term opportunities. Now let's talk about how to approach credit the right way. Building good credit is not about chasing tricks or hacks. It's about developing boring, consistent habits. Pay every bill on time. Keep balances low, avoid unnecessary applications, and be patient. There are no shortcuts that last. Credit systems reward stability over time, not quick wins. If you're starting from scratch, a beginner or secured credit card can help you establish history. Use it lightly and consistently. If you're rebuilding, focus on fixing behaviors rather than searching for instant fixes. Credit improvement is gradual, but it is possible for almost anyone. Here's the most important idea to take away from this entire video. Credit scores are not about perfection. They are about consistency. People with excellent credit are not perfect. They just avoid major mistakes and repeat good habits over a long period of time.